5 times. The CME Group raised margin requirements on silver 5 separate times in the last 6 weeks. December 12th, December 29th, December 30th, January 28th. And then, after the biggest crash in modern history, after retail investors got liquidated, after $10 trillion vanished in 6 hours, they did it again. Saturday, February 1st, 2026, one day after the massacre. When you raise margin requirements before volatility, you can claim you're managing risk. When you raise them during volatility, you can claim you're protecting the system. But when you raise them after the crash, after the damage is done, after the blood is already on the floor, you're not protecting anyone. You're making sure the price can't recover. You're making sure the people who got destroyed can't get back in. And this is the 3rd time in 46 years they've run this exact playbook. I know you got margin called on Friday. I know you held silver for months, watched it climb to 121ers, believed in the thesis, had conviction. And then Friday morning came. Your broker sent you a message: insufficient margin, liquidate or deposit cash. You didn't have time, you didn't have the cash sitting there, and you watched your position get closed at the worst possible moment. You lost money not because you were wrong about silver, but because you didn't have enough dollars in your account to survive a rigged move. And while you were getting liquidated, while you were watching months of gains evaporate in hours, the CME was already planning the next margin hike. To make sure you can't rebuild. To make sure the price stays exactly where they need it. They told you it's standard procedure. They told you it's for market stability. I'm going to show you what it actually is. And I'm going to show you that they've done this twice before, the exact same way, with the exact same timing. Let me take you through the timeline. 6 weeks ago, December 12th, 2020 Q4, silver is rallying. It's at $95 and climbing. The momentum is building. Retail is getting excited, and quietly, without a press release, without an announcement on CNBC, the CME raises margin requirements by 10%. If you were holding a silver futures contract, you suddenly needed 10% more cash in your account. Not a big deal if you have liquidity. A very big deal if you're using leverage, like most traders. December 29th. Silver is now at 105s. The rally is accelerating. Social media is buzzing. And the CME raises margins again. 25% this time. Now you need 35% more cash than you did 2 weeks ago just to hold the same position. December 30th, the very next day, they do it again. 2 margin hikes in 48 hours. This is not normal. In all of 2024, the CME raised silver margins twice. In the last 2 days of December, they did it twice. By the end of the year, traders needed 50% more capital to hold the same contracts they had in November. January 28th. Silver is at 118s, 3 days from the all-time high, 3 days from $121, and the CME changes the entire margin structure. They switch from fixed dollar amounts to percentage-based requirements. The new rate, 11%, up from 9%, and for some accounts it jumped even higher. That's 4 margin hikes in 6 weeks. By the time Friday came, traders needed 80% more cash in their accounts compared to early December. Now let me explain what this does to a market. When margin requirements go up, traders have 3 choices. 1. Deposit more cash immediately. 2. Reduce their position size. 3. Get liquidated. Most traders don't have 80% more cash just sitting in their account, so they either sell voluntarily or they get forced out. And when thousands of traders are forced to sell at the exact same time, that's not price discovery. That's a liquidation cascade. The CME knows this. They've been running futures markets for over a century. They know exactly what happens when you tighten margin requirements during a rally. And they did it anyway, 4 times in 6 weeks. Each time, the selling pressure increased. Each time, the market got more fragile. And then Friday came, the crash everyone now knows about. Silver from $121 to $75 in 6 hours. 40% destruction, the fastest collapse in the history of the metal. You'd think that after that kind of volatility, after that kind of damage, the CME would step back, lower margins, let the market stabilize, let traders who survived catch their breath. That's what risk management would look like. But that's not what happened. Saturday morning, February 1st, the day after the crash, the CME announced another margin increase. Gold margins went from 6% to 8%. Silver margin adjustments followed. They didn't ease, they tightened. And that tells you everything. Because if the goal was protecting the market from volatility, the job was already done. The volatility happened. The crash happened. The liquidations happened. Raising margins after the fact doesn't prevent anything. It only does one thing. It prevents recovery. It keeps new buyers from entering. It keeps sidelined traders from rebuilding positions. It ensures the price stays suppressed. Now let me show you why this matters beyond just Friday. This is not the first time the CME has done this. In fact, this is the third time in the last 46 years they've used the exact same strategy to crush a silver rally. Silver is running. It goes from $6 per ounce in early 1979 to $50 by January 1980. The Hunt brothers, two billionaire oil tycoons from Texas, are trying to corner the physical silver market. They're buying everything, futures, physical, mining shares. The rally is historic. Retail investors are pouring in, and the silver shorts, the big banks with massive losing positions, are getting destroyed. January 21st, 1980. The CME holds an emergency meeting. They create something called Silver Rule 7. Immediate implementation, no discussion, no warning. Silver Rule 7 banned new long positions in silver futures. You could only sell. You could not buy. If you were trying to enter the market, too bad. If you wanted to add to your position, illegal. Selling only. The Hunt brothers couldn't defend their position. The liquidation started, and it didn't stop. Silver went from $50 in January to $10 by March. 80% crash in 2 months. The CME didn't just raise margins. They changed the rules of the game mid-play, and they did it to protect the shorts. Silver runs again, from $8 in 2008 to $50 by April 2011. Another historic rally. This time, it's not the Hunt brothers. It's retail traders, online forums, people who watched the 2008 financial crisis and lost trust in paper money. Silver becomes the symbol of the anti-establishment trade. The shorts are suffering again, the same banks, the same positions. And the CME acts again. April 25th, 2011, they raise margins. April 29th, they raise them again. May 2nd, again. May 5th, again. May 9th, again. 5 margin hikes in 9 trading days. The initial margin requirement for silver futures went from $5,000 to $21,000. That's a 320% increase in less than 2 weeks. Traders couldn't keep up. The liquidation started. Silver went from $50 to $26 in 2 weeks. 48% crash. And just like 1980, the CME didn't ease requirements after the crash. They kept them elevated for months. It took silver 13 years to get back to $50. 13 years. Now 2026, same story, different year. Silver runs from $26 in early 2025 to $121 by January 2026. 365% gain. The biggest rally in modern history. Retail is euphoric. The silver squeeze movement is trending on social media. Millions of people buying physical. Institutions are nervous. And the CME starts raising margins 4 times in 6 weeks. Then the crash. Then another hike the next day. 1980, 2011, 2026. Same pattern, same timing, same tool, same result. Now let me ask you a question. If silver is just another commodity, if it's just another futures contract, why does the CME intervene every single time it threatens $50? Corn can rally 100% and there's no emergency rule change. Oil can crash 80% and there's no margin manipulation. Soybeans can do whatever and the market just trades. But silver? Every time silver tries to break free, every time it starts behaving like a monetary metal instead of an industrial commodity, the hammer comes down. And it's always the same hammer. Margin requirements. Raise them during the rally to slow it down. Raise them during the crash to accelerate it. Raise them after the crash to prevent recovery. It's not risk management, it's price management. And here's what they don't want you to calculate. Who benefits from stopping silver rallies? Who has the most to lose if silver goes to $200, $300, $500? The banks with short positions. The institutions that sold paper silver they don't have. The system that needs you to believe paper dollars are more valuable than physical metal. When silver was at $50 in 1980, the dollar was in crisis. Inflation was double digits. Trust in the currency was collapsing. When silver hit $50 in 2011, we'd just gone through the worst financial crisis since the Great Depression. Bailouts, money printing, zero interest rates. And now 2026, we've got the highest debt levels in history, more currency creation in 3 years than the prior decade, and a global move away from the dollar. Silver at $121 doesn't just mean silver is expensive. It means people are fleeing something. And the something they're fleeing is paper, so the paper system fights back. And the weapon is margin requirements. Let me be very clear about something. I'm not telling you to trade silver. I'm not telling you the CME is evil. I'm not your financial advisor, and I don't know your situation. What I am telling you is what the data shows. The data shows that in 1980, 2011, and 2026, the CME used margin requirement manipulation to stop silver rallies at almost the exact same price level. The data shows they raised margins after the 2026 crash, not before. The data shows this is the third time in 46 years they've run this playbook. And the data shows something else. Every time they've done this, silver eventually recovered. It took 2 years after 1980. It took 13 years after 2011. But it came back because you can manipulate paper price with margin requirements and rule changes. But you can't change the physical reality. The metal exists in finite supply. The demand is real. And the dollar printing continues. The CME can raise margins to 100%. They can require full cash payment for every contract. They can ban leverage entirely. But they can't print silver. And that's the difference between paper and physical. Paper can be manipulated. Physical just sits there, waiting for the manipulation to end. 5 times in 6 weeks. The last one, the day after the crash. 1980, 2011, 2026. The same playbook, the same target, the same result. They called it risk management. They called it protecting investors. They called it standard procedure. I call it the clearest proof that silver is the one asset they can't afford to lose control of. Because if silver goes to $200 and stays there, the question becomes unavoidable. Why? And the answer is the one thing the paper system can't survive. Loss of confidence. Now you know what happened. Now you know why your margin call came when it did. Now you know why they raised requirements after the crash, not before. And now you know this is the third time they've done it. The pattern is there. The proof is public. The CME's own notices are the evidence. If this video helped you understand why you got liquidated on Friday, share it with one person who went through the same thing. One person who's wondering why the system feels rigged. Because it is. Drop a comment and tell me, did you get margin called? I want to know how many people this hit. This is what they don't tell you. The margins go up when they need you out. They go up after the crash when they need you to stay out. And they've done it 3 times in 5 decades to the same metal at the same price. That's not coincidence. That's policy.